Hello guys, welcome to our channel. Today we are going to see about bonds. Bonds are nothing but debt instruments. So if you get money from someone, so you will have to sign a bond or agreement saying that I will pay this person from whom I bought this money with a certain amount of interest in this particular period of time. So that is called bond. Let us look at the history of bond markets. Bond markets are not a recent phenomenon. They have been in practice for ages. So even in 2400 BC in Mesopotamia, is now called Iraq, a clay tablet has been found which says that the financial agreement between a buyer and a issuer, and that this bond can be sold to some other person. So this kind of trading has been happening for quite some time. So even Dutch East India Company, they have issued these bonds for purpose of traveling or trading in the eastern India. So the bond market is where these kind of transactions happen. There are two types of bond markets. One is called the primary bond market, where the new issue of bond happens. The secondary market is where the already issued bonds are sold or traded again and again. So there will be some technical terms involved, right? So for the first one is called coupon rate. So when a new bond is issued, the company has to pay in interest. So they will pay it either annually, biannually, or sometimes even monthly. So this interest rate, whatever they are going to pay, is called coupon rate. Why it's called coupon rate? The main reason is that in earlier times, so instead of giving money, they used to give coupons for the interest that is getting generated at the end of the term, or after some time the coupons can be converted into money by giving it back to the buyer. So that is how the term coupon rate came into picture. The next important term is called YTM. YTM is yield to maturity. It is the total return on the investments, including the principal, the interest rate, and everything accumulated together is called yield to maturity. The most important term is called face value. Say, for example, you are buying a bond. So the bond will have some initial value, right? So, say, for example, you're buying $1,000 bond, the face value is $1,000. So, if you hold the bond for 3 years, the face value will never change. Similarly, everyone has to hold the bond. So, the bond will be issued for to multiple people, and if someone else trades the bond in the secondary market, the face value can change. And say, for example, you are having a bond of $1,000, another person also wants the same bond. You are not selling, but he is selling to someone else, and the bond face value will change at the end of 3 years. So what is the current face value? For that only the interest will be given, so not the original one with which it was sold. So what are the different type of bonds? The first one is called corporate bond. Corporate bonds are issued by companies who want to, say, start another unit, invest in their business, or invest in a new functionality, something of that kind. So there are two types of corporate bonds. So one is called investment grade bond, the other one is called junk bonds. Investment grade bonds, so the grading is done by some credit agency like S&P or Moody's or all those some other companies. Investment grade bonds have a very low chance of defaulting. Defaulting means not paying interest rate or not being able to repay the principal. So that is called investment grade bonds. Junk bonds, they will give a lot of returns, but they have a very high chance of defaulting. So there's a chance that they may not be able to pay the interest, they may not be able to even repay the principal as well. Government also issues a lot of bonds, primarily for development of a state, the construction of railways, or construction of some kind of agricultural land, something of this kind. So these bonds issued by the government are called government bonds. The next type of bond is called municipal bonds. Like government, so a bond is issued by the state or a district or a municipal body mainly for some kind of development or some kind of new project is called municipal bonds. So municipal bonds are also shortly called the muni bonds. The next one is the mortgage backed securities. Say we have a collateral of all the mortgages and someone is ready to issue a loan against this collateral of mortgages. This is called mortgage backed securities. The mortgage backed security is also in high risk zone because the value directly depends on the value of the house. The value of the house is higher than when the bond was issued, then the value of the bond also will naturally be higher. If the value of the house goes down, the mortgage backed security also goes down. The next important type of bond is called the emerging market bond. So bonds which are issued for countries which are in emerging economies. So these kind of bonds are called emerging market bonds. Emerging market bonds are quite popular. They have a high rate of returns, but also they have a risk along with them. How the bond market works? There are different scenarios. The first scenario is a straightforward scenario we saw about face value. Like if you hold the bond and if everyone holds the bond for the period of which the bond was issued, say for like 3 years the bond is issued, and at the end of the third year nothing changes, directly you will get interest on the face value of the bond. So in case someone else trades, the value changes, that is fine. So how this value changes? So first of all, we need to look at the current interest rate as well. So when you're buying a bond, you have to check the current interest rate and the interest rate the bond is given for. Say for example, you are buying a bond for 3% interest rate, market rate is 0.25%. Then you will have a very good bond. For example, in case you need to sell it in the secondary market, your bond is generating more money than other instruments which are using the traditional route or the market rate. So the value of your bond will go higher and you can sell it for much more amount than what the face value you initially bought. Similarly, say for example, you buy a bond at 3% interest rate for 5 years and now the interest rate is 0.25 and it suddenly surges, the current market rate surges to 5.5. So your bond value will come down. So in case you want to sell in the secondary market, there will be very less buyers because new bonds will be issued at higher rate and the instruments which are traditionally using the market rate will provide more returns. So the value of your bond will come down. So this is how bond market works. Bond markets are called fixed term markets as well for a reason because they provide exactly the fixed rate of interest what it was decided when the bond was issued. Where can we buy these bonds? So if you want to buy bonds which are based on equity, you can go and refer the S&P index or the Russell index. So in case you want to buy government bonds, so you can check the Bloomberg index which is called the AG, which primarily tracks government bonds. And if you want to check the corporate bonds, again these are the three indexes which help you track the corporate bonds. So what happened in Silicon Valley Bank? Silicon Valley Bank invested around $91 billion in bond market and they invested when the market rates were almost near zero. Then suddenly the interest rate started climbing and as mentioned before the bond value came down because many people started trading and the bond value came down to 76 billion. And when they wanted to sell, they had to sell at a loss because the depositors suddenly started demanding money and the spiral happened and finally the bank collapsed. So the main reason why the bonds failed for the Silicon Valley Bank is mainly because of interest rate. Hope you would have got a good idea of what the bond is, how it works, what are the positives, negatives, and where can you check for the bond rates and buy or sell. Hope you found this video useful. Please continue watching Canadian Fables. Thank you for watching and have a great day.